Okay, good evening, everybody. I'm just going to give it one more minute before quite a few people are joining. Okay, good evening. Welcome to tonight's webinar. We're really excited to be presenting this webinar again on practice transitions and how to protect the value of your practice through the dental office lease. We've got a great presentation tonight. Just a bit of housekeeping. This is a continuing education webinar, so you are entitled to 1 CE credit, which will normally be emailed to you at sort of 7 to 10 business days after the webinar. We will have some time for some sort of questions and answer session towards the end, but there is a chat section and a question and answer. So if you do have something that's on your mind, feel free to put it in the question and answer section, and we will certainly get to that at some stage. So my name's Lee Tessler. I'm one of the senior consultants at Cirrus Consulting Group. We're also joined by two lovely ladies from Tier 3, Sivan Kadian and Patty Ann Jones. So before we kind of jump in, you're going to see a couple of polls on the screen, just some introductory polls, which I'm going to launch now. If you could just take a minute or two just to fill in a couple of questions in terms of type of practice owner you are, what type of dentist. This just gives us a little indication, helps us cater tonight's lecture, so we know who we're dealing with. So a couple of you are filling that out now, which is great. And I'm going to just launch one other introductory poll from Cirrus's benefit, which is just trying to understand a little bit about your situation, whether you're planning to open a practice, acquire, transition, purpose of taking the course. If you have a lease, when does it expire? And do you plan to start or buy a new practice? And are you interested in a complimentary lease review and rent analysis? So I'm going to just give you a few seconds to fill that in. Hopefully everybody can see this on your screen. And also hopefully we will be able to get out and see people in person, get some feedback. So I'll just leave that on there for a few more minutes. And again, for those of you who joined a minute or two later, again, welcome to tonight's webinar, Western Canada webinar on practice transitions. We're really going to look at the value of your practice and how to protect that through the dental office lease. It's a two-part sort of tonight with the ladies, Sivan Kadian and Patty Ann Jones from Tier 3, who are going to kick us off on tonight's webinar. And then I will take over sort of halfway through, and then we'll have a question and answer section at the end. And again, just to repeat, this is 1 CE credit for everybody who's participating and joining tonight's webinar. So, Patty, I'm going to leave you. No, hold on a second. Before I join you, I'm just going to tell you a bit more of the purpose of tonight's webinar. So we're going to look at a little national market update on sort of, practice earnings, basic dental practice economics, how the lease agreement can make or break the sale of the practice, and also how to avoid some $100,000 mistakes that through the assignment clause particularly, which is the most important clause when it comes to actually transitioning and selling your practice, and also talk about how to mitigate risk and exposure and impacting your kind of estate and to protect your family. So hopefully you may not become experts after tonight's webinar, but I'm hoping that you'll be able to go away with more knowledge for sure than what you came with. So I will pass you over now to Patty.
Great, thanks, Lee. Welcome, everybody. Thanks for joining us tonight, especially after a long day of dentistry. As Lee mentioned, Sivan and I work for Tier 3 Brokerage. We are sales representatives and transition consultants. Just to give you a little bit of a sense of our background, Sivan has been with Tier 3 since it branched out into BC. She also has extensive experience with sales, marketing, and business development, and she also works with a not-for-profit organization in BC that brings mental health support to vulnerable youth in BC. I am a dentist. I also earned an MBA from Richard Ivey School of Business, and you may have run into me at some point when I worked at the BC Dental Association. I was the director, one of the directors of member services for about 7 years. In case you don't know much about Tier 3 Brokerage, we are a dental practice brokerage, a national brokerage. We have sales reps across the country and every province from coast to coast. Sivan and I work with BC dentists. I also work with dentists in Ontario, and I know that a number of you probably don't reside in BC, but rest assured that we have sales reps in your province, and Sivan and I would be happy to connect you with them if you want to reach out to us. And as you know, Tier 3 is now part of the Henry Schein family. Sorry, Lee, I can't advance it. Okay. You can flip it for me. Thank you. So Sivan and I thought we would start off with just a little bit of a market update and also highlight a few factors that are either currently impacting practice values and sales or have the potential to do so. The market is still very strong. It's a seller's market. All the various types of buyers are still looking to acquire practices. So owner-operators, DSOs, investor dentists, banks are still lending over 12 years at prime minus a quarter, and in some cases above appraised value. So the market is strong. We thought we'd highlight just a few things. The first one being the strength of COVID recovery. So this has really impacted practice value, or plays into practice value. Most dental practices have returned to their pre-COVID levels. Their patients are back, their revenues are back, so their values are pretty much back. But there are still practices out there who haven't quite gotten there yet. Maybe a number of their patients haven't returned. So in those cases, it's important that the dental office reaches out to them to reassure those patients that the dental office is a safe place and that it really plays a strong role in maintaining good oral health. Also, in some of these patients, their revenues are still down because either they continue to work at reduced hours, or maybe they continue with COVID protocols that are maybe over and above what's required. So there isn't full utilization of their space, and those things impact revenues, which then impact earnings and values. So those practices just need to get back on track, and once they're back to pre-COVID operations, then their value will return. Interest rates are not quite impacting practice values yet, but they do have the potential to do that down the road. You all know that the government has raised the interest rates. The prime rate has increased 3% to 5.45%. Since May, so borrowing has become a lot more expensive. For a purchaser, a $1 million of practice loan with the interest rates where they are is now going to cost them an extra $30,000 in interest annually, which is making it very difficult for those purchasers to meet the bank's debt service ratios at the current practice value. So what we might see down the road is banks may start lending less for a practice. And if that's the case, since most practice purchases are fully financed, that means that purchasers aren't going to be able to pay the same amount for practices. So we may start to see practice values going down somewhat. Staff shortages, that was an issue before COVID. It was made worse during COVID. And we know that that is still a very big problem for a majority of dental practices. And along with that comes the increase in wages due to supply and demand pressures. And this is really wreaking havoc with hygiene programs. And hygiene programs are a very strong driver of practice value. So if you're short a hygienist, then your hygiene hours are down. The patients can't get in for a hygiene appointment, which impacts their oral health. But also patients may leave to get to a point at a different dental office that can accommodate them. But if the hygiene hours are down, then the hygiene revenues are down. And that also plays into dental billings because a lot of the dental procedures are treatment planned in the hygiene room. So it is very important to try to retain the staff that you have. I know that's easier said than done, but it's not all necessarily about money. It's about really focusing on having a positive workplace and a favorable office culture. And also just maybe if you have to pay a little bit more for those wages, it's still better than having an idle chair. The National Dental Plan, that's still a really big black box. We know that the government has committed to financing for children in. Sorry. Never mind. I saw you flip back and forth there for a second. We're back to where we were. So the government has committed to financing committed to funds for children in families that qualify. But what's going to happen with values really depends on the overall implementation. If this plan focuses on vulnerable segments of the population, then that's going to be great because it'll increase access to care and it'll also increase the overall spend on dentistry. But if it's a broader implementation, if it's rolled out to everyone, then the employers may start pulling back their dental benefits, and that would be a negative for the public, for oral health in general, and for the dental community. But of course, what we're here to talk about today is the lease. And Sivan and I can tell you that most of the problems, or the most common problems that we see when it comes to practice sales, have to do with the lease. Lease issues can make, or a lease in general can make or break a sale. Certain lease issues could result in a pretty dramatic discount to practice value and also make it extremely challenging to sell a practice. Okay, you can flip to the next one, Lee. Thanks. So we're going to start with this question for you to contemplate. What is the most important determinant of your practice cash flow and selling price over the next 10 years? And that's specifically pertaining to the lease. Is it your annual rent cost? Is it the length of your lease, which would be made up of your current term and any subsequent renewal options? Or is it the various clauses and conditions in your lease? So Sivan and I are going to walk you through that. Sorry, guys. You know what? There's just a delay, so I don't know if it's... Can you bump me back one, Lee? Backwards. Go back the other way. Sorry, guys. There you go. Perfect. Thank you. So I'm going to cover what happens to value when there's an increase in annual rent. And so before we get there, I'm just going to give you a recap on how practice values are determined. The practice value, in a very simplified example, the practice value is based on a purchaser's expected future earnings. So say, for example, in this case, billings are $1 million. Of course, there are a number of practice expenses. We've simplified them here. The big ones are dental supplies, staff, and rent. We've lumped a bunch into other expenses. What's not included here are any personal expenses that are being run through the business, discretionary costs, non-recurring expenses or non-cash expenses like amortization, they are excluded from this calculation. So after we account for the cost, the earnings before dentist compensation is $500,000. But of course, anybody looking to purchase a practice is going to want to earn at least what they would as an associate in practice. So we build in a dentist compensation of 40% of just dentist billings, excluding lab. And so then we come up with the earnings after dentist compensation. And this is basically your EBITDA, so your earnings before interest, taxes, depreciation, and amortization. That is the cash flow that's left over and available to pay the taxes and also the bank loan. And how the practice value is determined is you take this EBITDA and you multiply it by an earnings multiple. And for a GP sale on the open market, the range of earnings multiples is somewhere in the 6 to 6.5 range. So we've used a 6.5 times multiple here, which results in a selling price of $1.56 million. Okay, Lee. If we drill down into the rent cost a little bit more, you can see that this $70,000 in rent is made up of base rent, property taxes, maintenance, and insurance. That's your TMI and GST. So that is how you come up with the $70,000. Okay, Lee. Now, what happens if the landlord bumps up the base rent by 20%? So now you go from a annual base rent of $37,500 to $45,000, and your overall rent expense increases by $8,475 from $70,000 up to $78,500. Okay, Lee. So here you can see we've gone from $70,000 in annual rent to $78,475. So that increase in $8,475 drops the earnings by the same amount. But because the practice value is based on an earnings multiple, then the practice value actually drops by 6.5 times that increase in rent. So the practice value drops by $55,000. Okay. Okay, Sivan, so what else could we find in that lease?
Hi, everyone. So thinking about these items, just imagine that what if you only had 4 years left on your lease term and you didn't have any renewals? Or how about there's that demolition clause in there that allows the landlord to terminate your lease in how many years? We don't know. But there's also things that could be in there like a relocation clause that can allow the landlord to force you to move to another suite at whose expense. Is that defined in your lease or not? That could be a very costly thing. So there's lots of things that could be hidden in a lease. And we know that Lee's going to go over some more options in there that you'll hear about tonight. But moving onwards, there's things that you can be doing, and we definitely recommend that if you're thinking about selling your practice or renegotiating your lease, it doesn't have to be for the sale of a practice, but definitely you should start planning at least 5 years in advance to think about where do you want to be in those years? Like, what's the future look like for you? So the further out you're starting to plan these things, the better off you're going to be, because really the devil's in the details. You need to be cautious because so many of these lease terms could really significantly impact your practice value and the saleability of it. So starting to plan several years in advance, because it could take years to sort out some of the lease issues. And often landlords, they're not willing to renegotiate until 1 to 2 years out. They don't have a lot of incentive to, and they know they have that upper hand there at times. So you want to work on that relationship, work on that discussion, and get some people in your, like, on your side to be supporting you in that. It makes it tough if you're in a 10-year term and you don't know what to do about what's next, but you still want to start planning for it. So I know, again, Lee will probably go into some details around this, but these are things that we run into quite frequently. Things that you want to think about, and that is your tenancy length. It's really important because a purchaser, they're really going to need a minimum of 12 years of tenancy certainty, because that's the amortization for a practice loan. And you really want to have that current term and then a series of 5-year terms along with that. And to maintain this, you want to make sure you're tacking on additional renewal options each time you renew. So those options are available to the potential purchaser. If you have less time than that, then the banks that are going to be financing the purchaser are often going to look at a loan repayment plan and amortize it over a shorter period that there's certainty for. So it increases the annual cash flow burden for a purchaser. So what your practice should be worth based on your EBITDA, a purchaser wouldn't be able to pay it because the bank's not going to be covering that if the loan coverage is not sufficient. Another thing to think about in that, we talked about that demolition clause. So there's our substantial renovation clause or termination clause. There's all different ones that can be mixed in there and how they're made up. But no tenancy, certainly, like I said, once a demo clause there is no certainty once a demo clause is exercised. And if it's in there, you can tell a bank or a purchaser or us all you want that, they're not going to do that. But if that's in the lease, then that's what the financiers are going to look at. The landlord may not have any intention of demolishing it, and they just that's their best option to put that in there to keep their options open. But it's pretty hard to convince a financer otherwise. So maybe they're just looking to renovate for a buyer that's offered them a higher amount for the space next door to you. And then they're like, well, let's get you out or move you somewhere else. Whose cost is that going to be? Because often the cost to move a practice, we base it around $300 per square foot. That comes out of what someone would be willing to pay for a practice, because that money's got to come from somewhere. So a purchaser wouldn't be able to pay as much for what you would hope for a practice if they've got to build that into their loan repayment plan. This also makes a practice less attractive to purchasers. There's a lot of risk involved in that. So there's a smaller pool of buyers and you're likely going to get lower offers. If you can't get that demo clause removed, then options are trying to get it deferred. The further it's deferred, the less impact on your price and saleability. You want to look at how much notice you get once that clause comes in as another option. So how much can you get? 12 months, 3 months, more times the better. So you really want to be able to have enough time to find and build a new facility so you're not having doors closed in that meantime. Oh, well, I do have control. Okay, or was that me? I don't know. So another thing to think about is that relocation clause. We talked about whose cost is going to be, are you going to get a same size? So what's the future look like for you? If they're moving into another unit and you don't have defined terms of what that looks like, you don't know what you're going to get and who's going to be paying for it. So those are unknowns that could be really costly. And then of course there's assignment. So if you're looking to sell and you want to assign the lease to someone else, make sure you know what's going on in there around that, because there could be consent required, or they might have the right to terminate the lease with if you want to assign the lease to someone else. So that can make it pretty difficult for someone trying to purchase a practice if they're stuck trying to negotiate with the landlord over what their terms would be. And that can really slow things down when it comes to sale of a practice. So there's also often a moving target to a closing date when there's assignment clause and having to reassign a lease to a new purchaser, because we can't really control that third party of that landlord of what do they want to do with it, what are their terms, what's the speed they're working at. So those delays can get really costly for your legal fees for both sides. And also that time that's taking to close the practice, there's going to be a lot of built up frustrations as that person's trying to negotiate that lease. So more time that's given before you can close a practice sale, then there's time for that purchaser to walk away if they're like, you know what, this isn't worth it. And that's the last thing you really want. All right. So we're just going to give you an idea here of about how a demo clause, for example, that could really impact the value of a practice. So for this one, the practice value is determined by 12-year forecast, like we talked about. So that's how long a bank loan is amortized for. So that's what you see here. We're really going to look at year one and write this. So it's got all those pieces that Patty Ann talked about. So your billings, your expenses, and then you go your earnings before dentist compensation, and after dentist compensation, then your cash flow after tax. So That's really what the banks will look at, that you're available to repay your bank loan for. So on this hypothetical practice sale of 1.56 million. So that cash flow is what they will look at that you have available to pay for your bank loan. Next. Okay, so looking forward here. So after you pay that loan payment in year one, there's $43,000 left over. Just a note here, I think it's really important to say that this is something we've used before and it hasn't been updated in a while. So you might realize here that interest rate is at 2.5% still, we wish, but it is not that anymore. So don't hold us to that. This is all this hypothetical practice numbers. So the banks like to look at a ratio, loan coverage ratio. So what do you have available to pay your loan after you've paid it, and what's left over? So just in case there's any variance, they want this ratio that they know that there's a cushion for you, that if this forecast doesn't go as predicted, there's some space for you to be able to pay it. So looking between 25 to 30% is kind of the goal. So we're looking at year one and year two, year three, like you see those red numbers at the bottom at 25%. So we're just right in that target mark. So we really look at that when we're appraising a practice and making sure when we're coming up with a value that these are realistic and aligned with what a purchaser is able to get financing for. But then on the next slide, we're going to show you that imagine you have to have a relocation cost built into your forecast here. So this demo clause, imagine, got kicked in year three with 1 year's notice. So the bank's going to have to assume when they're doing their own appraisal and analysis of this deal, that this demo clause is going to happen. So they're going to want to build in a move for year four, and the purchasing dentist is going to have to require additional financing to cover that. So we want to keep that loan ratio between that 25 to 30% there that we talked about. But you can see here that quickly after year four, that doesn't exist anymore if we're trying to still get to the value that we appraised the practice at originally. They don't have sufficient cash flow after payments to be able to maintain this value. So enough said, the bank would likely say they can't finance a practice at that full market value. So therefore the dentist can afford to pay the full market value. They'll likely come back to you and let you know what they're able to pay for the practice. And in this hypothetical scenario, you're looking at about a $300,000 to $425 drop in selling price. The further out you get that demo clause deferred, the less impact it's going to have on the practice value. But that rent increase that Patty Ann was talking about earlier really doesn't sound so bad anymore, does it, in comparison? So going back to that question that Patty Ann asked earlier in her presentation, so what's the most important determinant of your practice cash flow and selling price over the next 10 years? Trick question, of course. It's actually the two bottom, B and C. So the length of your lease term and the extension. So really having that available space in your lease that people can get appropriate financing for it. And then making sure that you're aware of the various clauses and conditions in your lease, because those can be really tricky and sneaky and not transparent at times. And you want to be able to understand what that means for you. And then you can help yourself when you're planning what does your future look like with the sale of this practice. It might motivate you to sell faster, so you can get around that, or you might need some experts called in, and I think we know some, if you need some help in how you're going to navigate that. So just to go over some of the key takeaways that we went over in this presentation. So like Patty Ann said, the leases and landlords, that's really the number one problem we have when we're selling practices. It's really unpredictable and really hard to stay on target. And because an improper lease, it can cost you hundreds of thousands of dollars and a lot of time. The terms are way more important than the lease cost. So it's great if you have your lease price, like it's below market rate, that's wonderful, but make sure that these other pieces are aligned as well. If you're just thinking about selling and you haven't thought about these things before, it's usually too late to make too much of an impactful difference. But you know, not to say that changes can be made and there's things that we can't do to help you make the best of that situation, but you really want to get out in front of it. So get your lease reviewed, negotiate when you have leverage, and you can call us and we can help you with these things. All right, thanks all.
Okay, sorry. Thank you, Sivan. Thank you, Patty. Okay, so 85, 54, 80. What do these three numbers represent? So 85% of dentists that have a lease that could prevent them from ever selling their practice, and 54% across North America are overpaying in rent for their practice, and 80% of landlords structure their lease to give them a right at least 50% of proceeds when a practice is sold. So I can't stress enough, and what the lady said in terms of what we want to do tonight is just really educate you to understand how much value that one can have in the practice, and how much value that relates to the actual lease, the space that you're practicing in. So just to give you a brief background about Cirrus Consulting Group and who we are. I mean, we're essentially a healthcare and dental specialized tenant representation firm. We were actually founded by dentists for dentists way back in '94 now, in Alberta, for the reason that the landlords were taking advantage of the dental and healthcare tenant. As you know, or some of you who have built out a practice or acquired a practice, is a very expensive business to enter into, and can be very profitable when it comes to transitioning. We have negotiated over 12,000 dental and medical specific leases. And we have an in-house legal and leasing and consulting department. And we represent really over sort of 500 doctors throughout North America. As you know, tonight's course is a CE accredited webinar. We do deliver over 100 CE accredited webinars and seminars, hopefully going forward. And we also lecture at most of the major dental convention centers, PDC, Greater New York, Yankee, California. So we really work with dentists nationwide. So this next slide, you may actually recognize some colleagues or some people that we've represented, and as you can see, from all over, from sort of Calgary, Edmonton, Saskatoon, Winnipeg, we really have supported the dental community. So just wanted to give a quick market update in terms of, you know, BC and Alberta, in terms of where we're seeing sort of market rents. And again, everybody that's registered and attended tonight is entitled to a complimentary consultation, whereby we can really look a bit more specifically at your location, your demographic in a little bit more detail. So, you know, this is just giving us a range. You can still see that the rents are upwards of sort of $50 in Vancouver in BC. And Calgary and Edmonton sort of average rates just around the $30 mark. In terms of vacancy rates, you can see here, you know, even though we have seen return to office reach its kind of highest levels since the pandemic, overall we're still seeing attendances, you know, below pre-COVID levels. As lots of employers continue to work from home, some or all part of the week. Any recovery and any continued growth is still challenging in the current climate, with historically high inflation and interest rates continuing to increase, which obviously increases the cost of borrowing. What we are seeing is that tenants, as they sort of gain a little bit more understanding in terms of post-pandemic requirement, new leasing activity has increased in the first half of this year. We are seeing a lot of new starts, relocations, second locations, as landlords trying to incentivize new tenants to their buildings. So, I don't want to go into each city specifically because we just don't have enough time. But we know that Calgary has suffered more than others, especially sort of downtown in the current climate, where sort of Vancouver still has the supply can't necessarily meet the demand. So, like I said, I mean, we have access to, we pay for a lot of proprietary data that we have access to. So we're able to really just hone into your specific location, look at the current market rates and vacancy rates in the area, and also look at what the sort of availabilities are. If the landlord was taking advantage, or if for whatever reason that there was a space that had come available due to COVID, that you may want to consider now relocating. We do talk a lot about leasing. Now, there are some of you that may be thinking about buying over leasing, and there may be some of you on this presentation who actually own the real estate as well as the practice. So, I mean, just a couple of things to just bear in mind. Buying obviously requires a large investment up front. You then become the landlord. Is that something necessarily you want to have that the sort of hassle and dealing as a landlord? You now become responsible. You do have greater flexibility on how you use the space, freedom and control. You don't have to ask permission. Whereas if you lease, you're requiring a smaller upfront payment, and then you have greater working capital to build a practice, and you have the flexibility to relocate or expand. So there's a number of sort of pros and cons on both sides of the fence, whether you're buying or leasing. I think the key thing that we want to explain is that whether you are leasing or whether you do buy a building, the dental office lease is still vitally important. Many times I speak to people that own their own building, and they say, well, I own the building, I don't need a lease. It's still vital to have a lease, even an arm's length lease between the building and the practice, to separate the two holding companies, or however you have that set up, because you have to understand in the future you may decide you want to sell the practice, but you want to keep the real estate. So you have to have some sort of history of rental payments to yourself. Anyone that's going to want to be able to finance a purchase of a practice, if you own the building, they're going to need to see at least the lender. So it's just something that it's important to understand. In terms of leverage, you're becoming the sort of anchor tenant now, right? You one of the best tenants. You have the lowest default rate in the country. You on average, statistically, stay at your space for over, I think it's 22 years. On average, people will stay at their space. So, you have to put yourself in your landlord's shoes and work out that sort of tenancy expense and what you're actually bringing to the landlord and to the table. So, our job really is educating the landlord as much as the dentist, right? We know that you're good tenants. and you may not have much experience dealing with commercial real estate or lease negotiation, and essentially you're busy trying to drive your, being chairside and drive your practice. And a landlord, this is what they do every single day. They know all the tricks, delaying the lease when it comes to sort of renewal. And what we want to do is just move the pendulum just to there's a balanced and a fair opportunity when it comes to negotiating your lease. I can't tell you how many people I speak to, and after about 2 minutes of the conversation, they say, "Well, my landlord, he never does anything. He's never going to change anything, and he won't negotiate because he hasn't negotiated with some of the other tenants in the building." And when we get involved and when we're retained, it's literally the opposite. The success we have, we'll see a little bit later in some of the sort of 5-star Google reviews. It's just about how you actually have the conversation strategically and explaining that, want to be here for a long period of time, right? But we have to protect our practice if we're going to invest in the space. There's certain things that we want to make sure that we are protected in the event of a death or a disability, and we want to be ensured that we can sell the practice in the future to an accredited dental practitioner. Just trying to really just even out the field. Like I said, this just reiterates that the best long-term tenant on the planet. We've got 27 years of experience. And our relationships and proven strategies, as I'll talk about a little bit further in terms of how we are successful. So in terms of your kind of lease, you have your financials and your legal provisions. There are 7 financial negotiables in your lease: base rent, annual increase. Like right now, landlords with inflation, historically has been sort of no more than 3%, and now we're seeing 7-8%. Many tenants or many landlords are costs of their costs are going up, and they're trying to pass that on to their tenants. So, what are your annual increases? What does that look like? Is your rent fixed for a period of time, or are they increasing in line with CPI? Also, common area maintenance. Is there a fixturing period of free rent if you're building out? Is there any tenant improvement allowance? And again, some people, landlords willing to give me $50 per square foot for tenant improvement allowance, $100,000. The bottom line, what I always say to all my clients is, there's no such thing as free money. That somewhere along the line, the landlord is going to get that back. So, we would analyze whether it's, is it right to take some money from the landlord, have some skin in the game, make sure that they do some of the landlord work, or if we're getting finance, do we borrow more from the bank? And again, now with interest rates going higher, these are all things that the components and variables that we have to take into consideration. So the importance of a properly structured assignment clause. Now, the reason that we're going to focus on the assignment clause is, just to follow on with what the ladies said earlier. The assignment clause, and this is an example which is found in 75% of dental leases. This one paragraph, this one provision, as we go through it, has 5 or 6, red flags that can prevent you selling your practice or, cost you additional money on the sale of your practice to actually get it through. I'll give you, 30 seconds just to have a quick read through the legal provision here. So So let's jump in then. This assignment, like I said, found in 75% of dental leases that we review on a daily basis. So the first thing we see is if the tenant should wish to assign or sublet the lease premises, it should first have received consent from the landlord. Now, this is quite common. No landlord is just going to let you transfer the lease to anybody. That they're going to want to have some control over their asset, and they're going to have to give certain amount of consent. But what does that consent look like? Can they delay the consent? If we look at the highlighted sentence here, the landlord shall have, in this case, 3 options. First option, just to approve the request to assign the lease or sublet the premises. 2, decline the tenant's request to assign the lease. And 3, can just terminate the lease agreement upon an effective date, such proposed lease assignment or sublet. So just for having the conversation and asking, Mr. Landlord, I know I've been at your space for nearly 30 years and sweated blood and tears, but can I please sell my practice? In this case, the landlord can just decline request and terminate the lease agreement. Again, what value is that going to put on your valuation when it comes to selling the practice? Yeah, you may have your goodwill, your charts, and your equipment, but the lease is the foundation of your practice. Is where your patients have been going for 30 years, and where their children and children's children want to continue to go to that location. Here, a little bit further down, it says landlords should have the right to revise the minimum rent to be paid during the remainder of the term or greater the current market rent for the lease premises of 15% greater than the current rent. So you've now asked the landlord again for permission, and the landlord says, sure, I've got no problem assigning the lease to the new buyer, but just to let you know, I'm going to increase the rents by 15%. Now, again, going back to Sivan and Patty in terms of some of their slides before, all of these little, minimal, big change in this circumstance is 15%. That's going to put a great impact on the valuation of your practice. And the landlord knows full well that there's a large transaction going to take place. There's reasons why they put some of this language in there. So it does actually get worse, unfortunately, but should the tenant receive from the assignee or subtenant any rental income, cash goods, any form of consideration in connection with the assignment of the lease, over and above the current annual rental rates, then other considerations shall be paid directly to the landlord within 30 days. So this is what we refer to as proceeds of sale or consideration language. Now, many of you say, you know, this is ridiculous, which it is, but I've seen it. I've actually, I work with a client who was desperate to sell his practice, and it was worth $2 million, and found a buyer, been trying to sell for a long period of time, had sort of proceeds of sale language in the lease. Landlord actually wanted 50% of the sale proceeds, which was $1 million. In the end, the doctor didn't want to lose the buyer. He actually cut a check for $263,000 to the landlord so that he could sell his practice. He's still taking 1.7 odd million because he didn't want to lose the buyer. But because it was in the lease, this language, he's having to cut a check to the landlord for $250,000, which is absurd, crazy. But we've seen it. It's happened. It does happen. I mean, this leases, they're not written specifically for a dental tenant or a healthcare tenant. And finally, if you do actually get through some of the language that we've just gone through, notwithstanding the landlord's consent to any assignment or subletting, the tenant shall not be released from its obligations under the lease and shall remain liable for any failure of the tenant in or its assignees or subtenants in the future. So now the landlord is actually saying, okay, you can sell your practice to, Mr. Smith, but if anything happens to Mr. Smith, if he, can't pay his rent, goes in arrears, takes on too much debt, goes bankrupt, you are going to remain liable. We had a client who was actually, I think it was in Red Deer. The family, they moved to Florida actually, and he got a phone call from the landlord 3 years after he had retired, saying, hi doctor, sorry to be the bearer of bad news, but your buyer has taken on far too much debt and he's been in arrears for the last 3 months. Unfortunately, you're going to have to pay those arrears, and the remaining 7 years that were on the lease is your responsibility. Now, the last thing that this doctor, who's taken his family and his wife and retired into Florida, wants to do is go back and start practicing dentistry. So, in some cases, you may have to provide some sort of continuing liability, but you just don't want to be providing that forever and ever. Amen. So, as you can see, just in this one paragraph, one assignment, the cost of this mistake, inability to sell the practice, having to absorb significant increases in rent if you remain a guarantor or a liability, and paying the landlord portion of your sale, anything from $250,000 to $750,000 liability. There are also a number of other hidden risks in your lease. The ladies touched on some of the relocation, option, death and disability, demolition. There are a number of other provisions that can often get overlooked and get missed. Again, for the interest of time, I'm more than happy to look at your own individual leases for any of these particular provisions that may cause a problem. But for the interest of time, I'm not going to cover all of these now. This slide is, I like to add this to my presentation. It's actually a slide that we had from one of my colleagues who's on the lease negotiation side, but did actually work on the landlord side, is what we'd sort of describe as a tenant lease cycle. As you can see, we recommend starting the process if you're coming up to expiry at least 2 years before expiry. I mean, if you're coming up to transitioning, you should start that process, not just the lease, but everything else, and try and get your ducks in order, 5 years before, to really plan with your financial advisor, your accountant, your, tier 3, the practice transition, valuation of the practice. There's a number of things that you can put in place. But when it comes to the lease, we recommend 24 months before expiry. Why? Because if there is a problem and you had to, for worst case scenario, you had to relocate the practice, you have time to do that, even if you don't want to. And the last thing you want to do is move or relocate. At least you have the time and leverage to actually make the landlord believe that that's something that you're willing to do. Now, from a landlord standpoint, they may be like, well, we've got plenty of time. We've got plenty of time. Apologies for the background noise. We have plenty of time, and come see us. You've got an option. Your lease doesn't expire for another 2 years. Now, what they're trying to do is really just get you into that sort of 8 month, really that sort of. If they can get beyond the option and deadline date, then most likely, if you have an option, you will have a critical date where you have to give notice. In some cases, it can be 12 months, 9 months, 6 months. But if you miss that critical date, then essentially the options become null and void. You don't have any options if you miss it. So it's really key just just to understand what are those critical dates. And again, these are things that, you know, we track for clients, for current client, existing clients. And there's nothing wrong with starting the process early. You don't have to commit to anything, but you want to give yourself the most leverage when it comes to negotiating. And I am conscious of time. Just talk briefly about, you know, why and how we've been successful for over 25 years now. What's our process? You know, like I said earlier, many times clients say, well, landlord's not going to negotiate. Why is he going to negotiate with you? Well, you know, I would argue that there's a number of reasons why they negotiate with us, not just the fact of how many leases we've negotiated, but, you know, our process, we don't just pick up the phone to the landlord. You know, we will gather all the documentation. We will spend, you know, an hour or 2 hours just to understand your practice, understand where you are, your career goals. We will then spend 3-4 hours just reviewing the lease for any sort of liabilities, any areas of concern. We will then conduct, you know, some market research, look at the vacancies, rental rates in the area, and develop a strategy in terms of how, you know, some of the key high, you know, priorities in the negotiation. In any negotiation, there's going to be some give and take. There's going to be some things that we're going to have to concede on, but some things we're going to fight tooth and nail for. You know, a demolition, a relocation, certain things that's going to be a high priority. There may be some other things that we're able to, you know, say, if we don't get that, you know, we can concede, but it may not be, you know, that vital to depending on, you know, where you are. And all these 5 stages I've just talked about, we haven't even picked up the phone to the landlord at this stage. So there's a lot of, you know, there's a lot of work that's done before, so that once we get on the phone or once we speak to the landlord, whether it's a big institutional landlord or a mum and pop, we know exactly who we're dealing with. We know what's happening in the area. You know, what's the availability, what you know, what people are paying, etc. You know, and then we start the negotiations. We find once we have a landlord motivated by the economics and you know, the rent and term, then they're much more likely to engage in making some of the changes in the legal provisions to make the successful changes to your lease. And here, just wanted to highlight some of the latest Google reviews. Dr. Amir Naz, I mean, his lease prevented him from selling the practice 3 times. This is a 74-year-old doctor who actually was forced to relocate, and he hired us, Cirrus. We not only relocated his practice to a better space, we got the new landlord to cover 100% of the build-out costs. You know, this dentist said it was the best money he ever spent on his practice. I'm not surprised. Again, just some other Google reviews. So just wanted to make you aware, as I was talking about the critical dates and risk analysis, something that normally has a $2,000 value. We spend 3-4 hours analyzing your lease for any traps, and then we would then schedule a call, discuss your vision and plan, and have a look what your lease looks like and what the ideal lease should look like for you, and come up with a sort of, you know, a strategy, a treatment plan. So you are invited to, because of our sponsors at Tier 3 and Henry Schein, to a complimentary lease review. And if you, this is a first come, first served basis. So if you are interested, please, I'm going to put some exit polls, and hopefully we've still got a few more minutes for some questions and answers. Hold on a second. I'm going to just launch the a final poll. So if you are interested in the complimentary lease review, also if you're interested in a complimentary transition planning consultation with Tier 3, I strongly recommend you take that opportunity to have that conversation. So I know that we are coming up to the hour mark. So I'm just gonna, if people are, if you're okay to hang on for a couple more minutes, I'm gonna just give it while some people closing the exit poll and see if we have any questions. If you do have any questions, there is a question and answer chat section that let me just have a look if there's any questions. Thank you to Wendy, who appreciates the fact that my dog is barking and can happen, even though I can see my wife in the corner of my eye yanking him upstairs. I do have another question. Actually, it says, when it comes to a demolition in the lease agreement, can you still sell your practice? So, in answer to this question, yes. I mean, in the GTA, in Toronto, in Vancouver, in many downtowns, there is a demolition clause in a lease, and it's been in that building for maybe 20, 30 years. So many practices change hands with a demolition clause in it. I mean, Sivan, Patty, I mean, you can probably back me up on that.
Yeah, I would say that a good majority of practices that we appraise and sell, if it's not owned by our client, the property, then there's usually something in there and that we've got to work with. And like I said, like you can sell your practice, but we talked about kind of that smaller buyer pool that are more risk averse, and they're just kind of like, you know what, maybe this might work for me. And it could be win-win, right? If you come to a common ground, if the demolition clause or termination clause doesn't come through, then they're likely gotten it at a bit of a discount, because we'd have to put some sort of like offering into our forecast, most likely, depending on the situation, right? There's a lot of factors that go along with it. So someone that's like, you know what, I might get a great practice for a bit of a discount because there's a demolition clause, and we could negotiate. Well, if it never goes through, then like you're just like laughing all the way, right? So you got to find some middle ground and negotiate between those two parts, and hopefully our client can come to a common understanding with the purchaser, that you meet halfway between what would an appropriate discount look like based on what the situation is. So that's something that we can navigate. Patty Ann? Yeah,
I think another part of that too is that I know the banks, I actually just recently had a conversation with one of the senior bankers in the healthcare group at TD, and he was telling me that absolutely, that when it comes to a demo clause, the bank will build, they run their own forecasts and how they think the cash flow that the purchaser is going to generate, expected cash flow, and they will build in that relocation cost. And if the bank's building in a relocation cost of $400,000, say in 3 or 4 years, then that is going to be money that they're not going to finance for the actual practice. So if the bank's not willing to finance the full appraised value of the practice, then the price the purchaser is going to be able to offer is going to be lower. That's how that discount gets built in.
Yeah, I mean, I think that, I've actually had 2 calls in the last 2 days where somebody was coming up for renewal and the landlord was trying to insert a demolition clause in the lease in a very sort of retail strip plaza, old plaza. Mm-hmm. Again, we're seeing it more and more. So I think what we need to understand is to make an informed decision. And yeah, a demolition is a red flag, there's no doubt. But there's a number of step downs if we can't remove the demolition and you know, the demolition clause is just not going anywhere, then, you know, can we put a blackout period? Can we, you know, ensure that that demolition will not take place for another 5 or 10 years? Or not just that, like, what is the notice period? In some cases, we're not able to remove it. Maybe we're able to, well, not maybe, I know that we're able to bring the notice period from 6 months to maybe a year or 2 years in some cases. So there's plenty of step downs, there's plenty of sort of elegant negotiables that can be had. It's not just a question of no, we don't really accept that. I am conscious of time. I do really appreciate everyone's time. I do have one more question. One more question, which says, I'm coming up to around 6 months from my expiry. Am I too late to negotiate? Now, the answer is no, you're not too late. Would we like to start the process sooner? For sure. You're never too late. Negotiations can take place 6 months before. You know, we've had ones where, you know, the lease was expiring within 3 months. They only had to give 3 months notice to extend an option. We were still able to have a successful negotiation. What we want you to just understand is, you know the critical dates that are in your lease. Understand that the earlier you start, the better leverage that you have. But you can still have a successful negotiation 6 months from expiry. And I think that's all the questions. I appreciate everybody's time. Thank you, Sivan. Thank you, Patty-Ann. Thank you, Wendy Jobs, who says that she's enjoyed the presentation. And again, please feel free to reach out to any of us for that complimentary consultation. It's on a first come, first served basis. And we wish you a nice, safe evening, and hopefully we will speak again soon. Thank you very much.
Thanks, everyone.
Thanks, everybody.
Thank you.